Most people think market crashes are random. A bad earnings report, a tweet, some geopolitical event nobody saw coming. Price drops, retail investors panic, whales swoop in and buy the dip. Luck, right? Wrong. What if I told you that the dip was planned, that the panic was engineered, that the moment you hit sell, you were the product? Because here's what nobody in finance wants you to understand. The market doesn't move randomly. It moves toward money. And the people with the most money know exactly how to make it move in their direction. This is the liquidity trap protocol, and by the end of this video, you will never look at a market crash the same way again. Chapter 1. The whale's burden. Here's something nobody explains. Big money has a problem. When a hedge fund wants to buy $500 million worth of Bitcoin, or Apple stock, or oil futures, they can't just buy it. Not all at once. Because the moment they start buying at scale, price moves against them. They create their own inflation. By the time the order is filled, they've already overpaid. This is called market impact, and for whales it's a permanent constraint. They are too big to act normally, so they don't act normally. To execute a massive position without destroying their own entry price, they need liquidity, a huge pool of available sell orders sitting in the market, ready to absorb their buy. If they can trigger enough selling, they fill everything they need at one price. Quietly. Efficiently. The question is, how do you manufacture that much selling on demand? Simple. You already know where it is. Chapter 2. The architecture of the trap. Here's something every retail trader does without thinking. They place a stop loss. It makes sense. You buy at $100. You set a stop at $92. If price drops, you automatically sell, cutting your loss before it gets worse. Responsible. Textbook. And almost every retail trader puts their stop in the same place. Just below support. Just above resistance. The obvious levels. The round numbers. The spots every technical analysis tutorial points to. Think about what that creates. A map. A predictable map of exactly where the majority of retail stop losses are sitting, and institutional desks can see that map. They have the order flow data, the liquidity heat maps, the tools that show precisely where retail stop orders are clustered. Those clusters are called liquidity pools. And to a whale, a liquidity pool isn't a danger zone. It's a target. Chapter 3. The stop loss hunt. Here's how the trap is sprung. A whale, or coordinated institutional players, begins pushing price downward, deliberately, toward the liquidity pool sitting just below a major support level. Price dips. Retail watches nervously. Price dips more, then it touches the stop level. Instantly, thousands of automated sell orders trigger simultaneously. Retail investors are ejected from their positions, and all of that selling creates exactly the volume the whale needs to buy. They absorb every sell order. They fill their entire position in seconds. At a discount, using your stop loss as the mechanism. This is called a stop loss hunt, and it's not a conspiracy theory. It's a documented market mechanic. Institutions build it into their execution algorithms. Retail loses their position just before the reversal. Whale gets a massive position at the bottom. Price shoots back up. You sold the exact bottom. They bought it. Chapter 4. Induced panic. But sometimes a liquidity pool isn't enough. Sometimes the whale needs even more selling. So they don't just hit stops. They engineer panic. Price doesn't just dip. It plummets. Fast. Aggressively. In a way that looks like the whole market is breaking down. Charts look apocalyptic. Influencers post, "Is this the end?" Financial media runs the unprecedented sell-off headline. And retail investors who didn't even have stop losses, who were holding through the dip, suddenly can't take it. They sell out of pure fear. That's called exit liquidity. The whale doesn't just need you to hit your stop. They need you scared enough to sell without one. Because scared sellers take whatever price the market gives them. And whatever price they take, the whale is on the other side, buying it all. The market looks broken. The market is not broken. It's working exactly as designed, just not for you. Chapter 5. The institutional footprint. If this is a system, it leaves evidence. The high-volume wick. After a major reversal, look for a long candle wick. A spike down that snapped back immediately. That's the exact moment the liquidity pool was hit, stops triggered, and price recovered once the whale filled their position. The wick is the fingerprint, the order block. Before a big move, institutions accumulate gradually, using a mix of buy and sell orders to disguise what they're building. That price range, in hindsight, is an order block. When price returns to that level, it tends to react strongly. Same institutional interest. Still there. Volume divergence. Price drops sharply, but volume is unusually high. That's not panic selling into nothing. That's retail selling being absorbed by institutional buying. Genuine collapse looks different. Absorption looks like a wall. These signals don't predict the future, but they shift the question from what is price doing to who is doing it and why. That's a fundamentally more useful question. Chapter 6. The Mindset Shift. This is the real point of the video, not the mechanics, the mindset. Retail traders are reactive. Price drops, they panic. Price spikes, they chase. Always one step behind. Always interpreting what already happened. That's not a flaw in the trader, it's a feature of the system. Reactive behavior is predictable. Predictable behavior is exploitable. The shift is this. Stop asking, what is the market doing? Start asking, where is the market going to go to collect the most liquidity? Because that's the question institutional money is always answering. They're not reading the news. They're looking at where the most stop losses are clustered, where the most retail emotion is concentrated, where they can manufacture the conditions they need. When you see a dip, retail asks, is this a crash? The whale asks, whose stops are we hunting and what level do we need to reach? One leads to panic. The other leads to a plan. The news doesn't move markets. The news explains moves that already happened or creates the emotional environment to make the next move possible. What actually matters is the mechanics. Who needs what? Where is the liquidity? What does the footprint look like after an institutional move? That knowledge doesn't make you a whale, but it stops you from being the prey. The wealth transfer happening in financial markets every single day is not random. It is not chaos. It is a protocol. And now you know what it looks like. The next time the market crashes, don't ask what's breaking. Ask who's buying.